Is China's collapsing property market the next big global economic shock? With major developers defaulting, prices falling, and investor fears rising, the world is paying attention.
It's been a volatile week for Evergrande, to say the least.
Recently there has been too much bad news surrounding this name.
Could this trigger financial instability beyond China's borders? Or is it just a regional shakeup? Stay with us as we break it all down in today's deep dive. Before we begin, don't forget to like, share, and subscribe to our channel for more insights into global finance. The size and importance of China's property market. China's real estate sector is not just large, it's enormous, contributing close to 30% of the country's gross domestic product when linked sectors are included. Unlike other economies, Chinese household wealth is heavily tied to property, with over 70% of household assets locked in housing. This makes any fluctuation in the market deeply personal and economically widespread. Ghost cities and excessive construction have left developers with thousands of unsold units. Over time, speculative demand slowed, and demographic trends began to reverse. With population growth slowing and urbanization plateauing, China's property market is entering a structural correction. As it weakens, so does national economic confidence, making the risks increasingly global in scale. Evergrande, Country Garden, and Developer. Trouble. The downfall of Evergrande in 2021 exposed deep financial fault lines within China's property giants. Carrying over $300 billion in liabilities, the company's collapse triggered panic in both domestic and international markets. But it wasn't alone. Country Garden, another industry titan, narrowly avoided default, but continues to face repayment issues as of mid-2024. Other big names like Kaisa and Sunak have followed suit. The common thread? Reliance on pre-sales and mounting debt. As home buyers lose trust, pre-sale revenue dries up, halting construction. The result is thousands of unfinished homes and unpaid contractors. Mortgage protests and street demonstrations have intensified, showing how this crisis is hitting everyday citizens, not just developers or investors. Shadow banking and hidden financial risks. Much of the current crisis stems from China's little-understood shadow banking sector. For years, developers relied on opaque funding from trust companies and high-yield wealth management products sold to the public. This non-bank financing added trillions in hidden debt to an already fragile system. Reuters reports over $3 trillion in shadow debt connected to property, much of it unrecoverable. When trust firms like Zhongrong defaulted, investors were left exposed. Many of these investments were believed to be safe, but the reality was far riskier. Because this debt isn't officially tracked on government balance sheets, it becomes a ticking time bomb. The risk isn't just default, it's that no one truly knows how deep the hole goes. Government response: effective or insufficient? The Chinese government has taken several steps to contain the real estate fallout, but critics argue it's been too little, too late. The Three Red Lines policy introduced in 2020 aimed to limit developer leverage, but it choked off critical cash flow just as markets turned. Since then, Beijing has relaxed mortgage requirements, pushed banks to extend credit, and even created bailout programs. Yet property investment fell nearly 20% in 2023 alone. Local governments, previously reliant on land sales, are also cash-strapped. While some state-owned firms have been tasked with completing stalled housing projects, the rollout has been inconsistent. Without restoring buyer confidence, these policy measures are only patchwork solutions, not structural fixes. How China's real estate woes affect the world. What happens in China doesn't stay in China, especially when it comes to real estate. The country's property boom once fueled global demand for resources like steel, copper, and cement, benefiting economies from Australia to Brazil. Now, as that demand falls, commodity exporting nations are feeling the squeeze. In the first quarter of 2024, Australia's iron ore shipments dropped 14%, highlighting the scale of the downturn. Global financial institutions are also at risk. Pension funds, asset managers, and banks with exposure to Chinese developers have seen significant losses. Even if you don't own Chinese assets directly, Ripple effects through trade, investment flows, and consumer sentiment can hurt your portfolio in unpredictable ways. China's middle class and consumer confidence. For decades, real estate symbolized wealth and security for China's growing middle class. Parents bought homes as dowries or retirement savings, while young couples viewed ownership as a rite of passage. But with prices down and projects unfinished, that confidence is unraveling. According to government data, major city home prices dropped over 7% year-over-year in mid-2024. Retail sales and personal spending are also slowing as households reassess their financial security. Many are now facing negative equity, where the home is worth less than the mortgage. Young adults are losing faith in homeownership as a pathway to stability. This declining sentiment could hurt China's broader economic ambitions around domestic consumption and social cohesion. Foreign investors and corporate exposure risks. International investors have long looked to China as a high-growth frontier, but the real estate meltdown is forcing a rethink. Hedge funds and asset managers like BlackRock and Fidelity have faced losses from Chinese bond exposure. Construction-related firms, including Caterpillar and Lafarge, report falling orders. Even global banks like HSBC and Standard Chartered are reviewing their China strategies. On the regulatory side, foreign companies now face increased challenges navigating capital controls and repatriating profits. Multinationals are eyeing Southeast Asia or India as alternative hubs. While China remains a strategic market, the unpredictable nature of its property crisis and government interventions is causing firms to recalibrate their risk models and long-term expansion plans. Could this become a global financial crisis? Is this China's version of the 2008 Lehman Brothers collapse? While there are similarities, massive debt, failing institutions, and fading trust, there are key differences too. China's financial system is more centralized, giving authorities tools like forced lending and capital restrictions. Still, the core issue remains: confidence. When buyers stop buying, developers can't finish projects, and banks tighten lending. This creates a downward spiral. Recent interest rate cuts and relaxed lending rules have failed to revive demand. Experts fear a Japan-style stagnation, not a sudden crash. But prolonged weakness in such a massive economy could reshape global financial flows and inflation patterns for years to come. The world is watching closely. What smart investors should be doing now? If you're invested in China or global markets, this is the time to review your strategy. Direct investments in Chinese property or developer bonds carry obvious risks. Reducing concentrated exposure to China can help buffer volatility. Monitor funds and ETFs with heavy China allocations. Commodities, currencies, and tech stocks could all be impacted. Central banks like the Fed and ECB are also tracking this closely as it could affect global inflation. Some investors may find bargains, but timing will be critical. Consider shifting to more stable regions or industries with lower correlation to China. Staying informed, nimble, and diversified is the best approach right now. China's property crash is not just a domestic issue. It's a global concern with real consequences. From falling investor confidence to slowing commodity demand, the situation may not be catastrophic, but it's far from over. Stay alert and strategic as events unfold. If you found this video helpful and informative, please hit the like button, subscribe to our channel, and share your thoughts in comment section below. Thank you.